Welcome back to another episode of In the Money. I'm Roberta King, and with me today is Jessica Inskip, Director of Education and Product of Options Play, and Tony Zhang, Chief Market Strategist of Option Play. Both Tony and Jessica are frequent contributors of CNBC. And Jessica and Tony, welcome. It's so great to be back with you today.
Thank you, Roberta. We are so happy to be here.
Yeah, pleasure to be here. Thank you for having us.
Absolutely. So I feel like every time I see you, I feel this way. And again, it's today. The financial world continues to be full of news. And today I'm really interested, Tony, in hearing your thoughts on the market. Can you break down your current view?
Yeah, absolutely. So broadly, over the past few months, we've been talking about that downward channel on the S&P 500. And this week, we actually finally got to test one of the resistance levels, the upper band of that channel. And our base case, which is the fact that the markets will continue to stay in this downward channel, so far has been confirmed on the back of what has been weak retail sales and PMI numbers yesterday that rejected the S&P 500 off of that top resistance level. So from my perspective right now, the base case remains that the equity markets will remain in this downward trend, stay within this channel, unless some kind of catalyst, such as a Fed pivot or earnings catalyst that really drives the markets outside of that. But for now, my expectations, given the fact that the retail sales numbers that came out yesterday was quite weak, it aligns with our overall bearish view that the economy is slowing down and that perhaps things need to get a little bit more worse before the Fed considers that pivot.
Yeah, that's fair. And I always find that retail activity count coming out in December is a topic that regularly gets the economist's attention, including my own. Thank you for your thoughts there. Jess, I'm curious to know, what indicators are you paying attention to?
Absolutely. And I second Tony's perspective. We are absolutely respecting that downwards trend line and that channel. And what is interesting as of late, as we have those early reporters of earnings, this market or the broader markets is reacting really excessively to earnings, more so than FOMC announcements. Now, earnings season is really ramping up now, and the vast majority of stocks are going to be week 2 and 3, which is the next 2 weeks. What I find interesting from a technical perspective is if you think about the last 2 earnings cycles, we were actually at the bottom of bear market rallies. And those bear market rallies were fueled by a resilient consumer because earnings expectations were beat or slightly better than anticipated, not as bad. Those were some of those headlines. And so that fueled the bear market rally to that downwards trend line. This earnings season, however, we're beginning at that downwards trend line, which reiterates Tony's point. We need a catalyst of some sort in order to overcome that. And we are in a pivotal moment. And a catalyst could be in the form of earnings, which is really, really ramping up within the next 2 weeks. And then we also have an FOMC decision on February 1st. So it's really, really an eye on the consumer and earnings, and of course, interest rates as per usual.
Yeah, that's interesting. Thank you both for your perspectives this week. Tony, I'd love to take a look at what kind of trading strategy you've got your eye on this week as well.
Yeah, the sector that I have my eye on this week is actually energy. Energy has been by far the best performing sector in all of 2022, and I have some signs that perhaps that outperformance is starting to come to an end and it could start reversing lower. So let's take a look at a few different charts to help understand why I have this specific view. The first chart I want to take a look at is XLE relative to SPY. That's the energy ETF relative to the S&P 500 ETF. And what we see here is what you would typically call as a classic head and shoulders pattern that is starting to form. But the one thing we want to understand here is effectively what we have is that energy outperformance ended in November of 2022. And what we have is a failed breakout towards that November 2022 breakout that we're back to that June highs that we are trading from last year. And this completes a potential head and shoulders pattern, which is a long-term topping formation, which shows that not only is the outperformance over, that we could start to see some significant underperformance from energy going into the second half of this year. So that's the first clue that I'm looking at in terms of energy potentially starting to underperform. The second chart I want, and I do want to point out here, is that the first chart we're looking at is a ratio chart. And what that means is that it only gives us a sense for relative performance. How is energy doing relative to the market? It doesn't give us a true directional view. The second two charts that I want to take a look at are absolute charts, and that gives us a better sense from a directional perspective. And the second chart I want to take a look at is USO. This is the ETF that tracks crude prices. And what you've seen here is that crude has essentially been trading roughly sideways for the last few months. USO has been range bound roughly between 65 and 70. And it's also been recently trading up against what has been a downwards trend line around that 69 level. And my concern here is that it's at risk of turning lower and potentially getting rejected at that trend line. And the last chart I want to take a look at is ConocoPhillips. ConocoPhillips is one of the names within the XLE ETF. It has about a 5% weight, a 4.5% weight of the XLE ETF. And what we see here is a chart pattern very similar to the relative chart of XLE to SPY. And what we have is a recent failure to break out higher and coming back to complete what could be a right shoulder here around that 124 level here on ConocoPhillips. So this is another sign that the outperformance here for energy is potentially coming to an end. And my downside targets here for ConocoPhillips is close to around $100 or so. So the trade structure that I want to take advantage of this potential underperformance here for energy is to use a call credit spread. And the reason I want to do this is because the head and shoulders formation itself, it doesn't particularly have a catalyst. So from my perspective, even though options are fairly inexpensive, I don't think buying options in this particular case, buying puts or even put spreads, makes a lot of sense. My thesis is that I don't think that ConocoPhillips will surpass these levels around that 124 level. So I'm going out to the March 3rd weekly expiration, and I'm selling the 118, 128 call spread, collecting earlier today about $3.70 for this call spread. And what this gives me is the ability to profit as long as ConocoPhillips stays below roughly 120, 170 or so. And this allows me to potentially profit even if ConocoPhillips rises a little bit higher or lowers from where we are today, effectively holding this head and shoulders pattern and risking, in this particular case, about $630 per contract if ConocoPhillips does break out higher and is above that upper strike of 128 on that March 3rd expiration.
Nice, Tony. Thank you. This is interesting on a couple levels. I do appreciate your charting there and the education on head and shoulders trend lines there. And it's an interesting sector to continue to monitor and find opportunities in within the current business cycle we're in. So thank you for sharing that. Jess, what sectors are you considering when looking at your trade ideas this week?
Yeah, my focus is absolutely on consumer discretionary. And so on that consumer and retail sales really back that thesis. So we can see on the screen with the chart is retail sales did not meet expectations. In fact, they were below in all categories. So that indicates to me that there is absolutely cracks within the consumer. And in addition to that, we had a Beige Book reading yesterday that gave us an indication that there is contraction overall. So all pointing to cracks in the consumer and a decline in retail sales. And I actually found this very interesting because if we go back to November, the peak shopping season, if you will, on Black Friday, it peaked. We had headlines of record sales over years, but it seems like the investor was searching for a deal and it only peaked during that time frame. And clearly, as the data depicts, declined. So therefore, I want to capitalize on that decline and take a bearish view on consumer discretionary utilizing the ETF XLY. Now, if we look at the chart and from a technical perspective, I actually found this a little contrarian as I was going through my normal charting process on absolute charts, relative charts, and so on and so forth, because what you can notice is XLY, it is making lower lows, and I do see it testing or finding support on its lower support level. Now, depicted on the chart, that lower support level is around 136. We have gone below that, but the next line or zone is still around 135. But from a technical perspective and thinking about the broader markets, as the S&P 500 has been at the bottom of its bear market rallies or has its downwards trend, the S&P 500 test its lows and is not making a newer low every time, but consumer discretionary in this ETF specifically, as you can see across the chart, is making newer lows. So that indicates to me additional weakness and can support a technical thesis. Now, from the trade perspective, I am looking at a bear put spread. Volatility is on the lower side of the range. And as we kick up into earnings season, so we're in week 1 now, so week 2 and 3 is going to start next week and the following, consumer discretionary kicks off next week. I expect volatility to increase. And because I expect it to increase, that's going to benefit me taking a long position. It gives me a positive volatility exposure. Now, the strikes that I chose is I'm purchasing an at the money strike. So this is the 136. And then I am capping my profit potential. This makes profit as the stock continuously declines. So my short strike is at 125. Now, that would be a new low for this security, as the low that was depicted on the previous chart was 126. But I expect that to happen because this security is continuously making newer lows. That previous low was in late December. So therefore, I am anticipating an increase in volatility, which will make contracts more expensive, which will help a long position. And I expect consumer discretionary to be the worst performing sector as we kick off and really ramp up into earnings season. And I want to take a broad-based view on that. Therefore, I'm using XLY. And it's important to note as well that I wanted to make sure that I had a 3-to-1 risk reward ratio, spending about 315, and we'll make max profit on expiration if XLY reaches down to 125.
Interesting, Jess. Thank you. I appreciate both of you talking about sectors this week. And as many of our traders know out there, that there are opportunities in every market. So I want to say thank you, Jessica and Tony, again today for your insights. And thank you, viewers, for tuning in. For more trading and investing insights, please sign up for Fidelity's weekly Active Trader newsletter. And you can find it by going to fidelity.com/Active Investor Weekly. We'll see you back here next week for another episode of In the Money. In the meanwhile, take care.